Welcome back to the channel. As part of doing the series around profound investors, I'm going to pick probably one of the most popular modern ones, which is Warren Buffett. And I want to talk about in this video why Buffett, despite being one of the best, arguably one of the best single stock buyers, is actually recommending to most people to become index income investors. So we're going to take a look at what was his reasoning behind it and does it make sense? So who is Warren Buffett? So he's typically referred to as the Oracle of Omaha. So Warren Buffett is the CEO, he's just actually stepped down, in fact, of Berkshire Hathaway and widely considered one of the most successful investors in history. Despite his immense wealth and skill in picking stocks, his primary advice for the average person is surprisingly simple. He has a net worth of over $100 billion. His philosophy is value investing and long-term holding, and he's pledged 99% of his wealth to charity. And so his first point is the tyranny of fees. So costs eat your future. So Buffett warns that high management fees charged by active funds, which are often around 1 to 2%, drastically erode compound interest over time. Index funds, by contrast, often charge less than 0.05%. Over investing lifetime, these small differences can amount to hundreds or thousands of dollars, pounds remaining in your pocket rather than the fund manager's pocket. Active managers rarely win, and I did a separate video on this earlier. Over a long period of time, the vast majority of active fund managers fail to beat the market index after fees are accounted for. And we can see the S&P 500, if that's the benchmark, small cap funds, 90% underperform, mid cap, 95% underperform, and large cap, 90% underperform. That does mean there are some outliers, of course, but this is in the general context. The $1 million bet. So in 2007, Buffett actually made a $1 million bet that a simple S&P 500 index fund would outperform a basket of hand-picked hedge funds over a decade. The result, quite simply, the index fund crushed the hedge funds. The index returned 7.1% annualized, while the hedge funds averaged only 2.2%. This kind of proved that high fees and complex strategies often lose to simple market tracking. He also had a philosophy of never bet against America. So Buffett believes the S&P 500 is essentially a bet on the economic power of the United States. By owning the 500 largest companies, you're participating in innovation, growth, and resilience of the American economy. Now, with recent things that are going on in the markets, some may argue that may no longer be the case. I'm still of the opinion that the S&P 500 still contains a large amount of companies that are well established across different markets, and their kind of income and revenue is not just based on the US economy, it's based on the global economy. And you could argue maybe that rather than the S&P 500, you could invest in a more diversified basket, such as an all-world fund. And again, I've done a separate video on the all-world funds. Now, obviously, a large proportion of those all-world funds are still 60% US based, but then you've obviously got some more global diversity built in, which is what I personally invest in. Another thing is instant diversification. So instead of trying to pick the one needle in the haystack, index investing lets you buy the entire haystack. You own tech, health, finance, and more. And I quite like this, the fact that you've got that broad exposure when you buy an index fund that has a lot of diversity in it. If one market struggles, another market will typically benefit from it. Risk reduction. If one company fails, it has negligible impact on your total portfolio. You eliminate the risk of a single stock crashing your wealth. And this applies to the S&P. It also applies to these all-world funds. There is some argument, however, that over-diversification can be just as a negative as under-diversification. That probably could be argued either way, I'm sure. The other advantage of index funds is they typically self-cleanse themselves. So the index automatically adds growing companies and removes failing ones. And we've seen that if you look at the S&P 500 50 years ago, 100 years ago, it will look very different to how it looks today. Previously, you would have seen oil and gas companies in there, for example. And now it's flooded with tech and innovation and finance. So you always own the current winners without lifting a finger. It also removes one of the biggest, I think, issues with investing, and particularly retail investors, is yourself, the enemy in the mirror. Buffett often says investing is not about IQ. And I agree, it's about temperament. Active stock pickers often panic when stocks fall or get greedy when they rise. The index advantage, index investors commit to a system. By setting and forgetting, they avoid the emotional mistakes of buying high and selling low that plague individual traders. The one thing I would say that is I've actually seen, even with income investing, people do tend to buy and sell. I never quite understood why, what causes them. Is it just a natural fear? Typically, these index funds drop a lot less than single investments, but it is still a temperament thing and not the ability to ride out those waves in the market, which we're currently experiencing right now at the time of recording as well. The other thing is simplicity is the ultimate sophistication. So no expertise required. You don't have to read balance sheets, watch financial news, understand macro, microeconomics. Buffett argues that a know-nothing investor who buys an index fund will outperform a know-it-all professional. Now, I'm sure professional investors would argue the case there, as would financial advisors, etc. The simplicity gives you back your most valuable asset, which is time. So, in summary, Warren Buffett said, consistently buy an S&P 500 low-cost index. I think it's the thing that makes the most sense practically all of the time. So there you go. That was kind of Warren Buffett's kind of philosophy around why, despite he himself actually buying single top stocks and doing all of this analysis, he recommends the average retail investor simply just holds an index. Let me know in the comments, guys, how do you invest? Do you pick single tickers because you have a belief in a particular single stock, whether it be Nvidia, Tesla, or do you actually go and buy the S&P 500 or the All World Index, or do you have a bit of a mix in your portfolio, or do you use other types of hedges like options trading and options vehicles to own a percentage of that underlying, but also have that options overlay as well? Let me know in the comments. I'd be curious to know how people invest and the way they invest. As always, none of this is financial advice. It's for entertainment purposes. Hopefully you enjoyed it, and I will catch you on the next one.